Hi everyone, welcome to the July 9th, 10th?
10th
edition, yeah, 10th edition of, July 10th edition of Traders Insight. I'm Sam.
And I'm Matt.
And let's jump right in. First thing that we saw, we were going to take a look at oil first, but really we want to take a look at Apple.
Absolutely. Look at this move. It's about time. I've been net short this stock for a long time, so it's nice to actually see it start to make some sort of pullback.
Yeah, this is huge. I mean, this is the 200-day moving average down here, and it's just about coming down to touch that. So this has been a huge move in the past 2 days. It's broken out of the wedge formation. Let's just draw a simple trend line. Oh, not a fit. If we draw a trend line, what you said you had the wedge coming through like that?
Yeah, if you had the wedge coming through, you see it broke through the wedge there.
Yeah.
That would have been a perfect shorting opportunity as soon as it had a daily close behind that, below that.
And we've also seen it
through the trend line, medium-term trend line as well.
Medium term. And if we come out to the weeklies as well too, once this comes up, which is being slow, we can see that it's also not that low one, but this one from down here, it's also broken through as well.
So it's broken multiple trend lines, so multiple support. So there's a lot of weakness in this stock. Obviously, Apple's going to drive the Nasdaq quite a lot. It has a very strong beta-weighted correlation to it. It's around 90% or 95%. But I mean, in the short term, how can we trade this? Well, I think Apple's IV percentile is around 68%.
Yeah.
Earnings are coming up around the 21st or the 22nd of July. So, I'd be only looking to do like a 7-day play out of this, because vol is going to start to expand now. Vol usually starts expanding 2 weeks before.
Why are the minis at 146 right now?
It's probably just counting in some earnings play or something. I don't even take into account minis. I don't even look at it.
Right, okay.
Volatility within a stock starts to expand 2 weeks before an earnings play. So we don't want to go out to a 40-day or 50-day period. So if we're looking at the 7 days, IV percentile at 68%, we can see that Apple's been relatively oversold, very, very short term. And what I want to do here is I want to sell some puts, for a 7-day period, just to capitalize on some sort of up move or some sort of contraction in volatility. Because I can't see VIX staying around the 20 handle for that long. So we want to take advantage of high volatility at the moment.
You could probably come pretty far away from the at the money strike as well.
Yeah, well, I mean, not if we can go to a 62%. Let's try selling a one strike wide first of all. Just check the premium. Yep.
So, oh my gosh, vertical. 33 cents. That's
okay. So that's not bad. So that's risking 3 to make 1.
No, it's 2 to 1.
2 to 1. There we go.
Yeah. That's not that bad.
That's not bad. Okay. What we want to do then? Let's widen out the strikes. Let's widen it out to 17.
Right, 60 cents. That's still pretty good.
That is very good.
Do you want to go further out?
Yeah, let's go down to 16. Okay, now let's go and confirm and send. That's looking far better. 816. So it's not even 3 to 1. So I want to get out further. I'm always willing to risk around 3 to 4 to 1 to do this. That's much better. We want to play around with it a little bit. So we could do the 119, 115, or we could try and get out to the 117. Let's try and check out the 117, 115. Okay.
It's not so great.
Yeah, that's just over. Risking 4 to make 1.
Well, it's 4. Yeah, I guess it's 4 to make 1.
So that's still not too bad either on a 7-day one.
Yeah.
I would be. Now I think we should stick to what we did before.
119s.
Yeah, 119s, 116s was it? We did.
Yeah, was it 119, 116?
Yeah, the reason why we're having wider strikes here is because our return on capital per day increases. Ultimately naked calls and naked options is better. However, if you want some of that defined risk, having wider strikes, having much wider strikes increases your return on capital per day, which is nice. And as you can see, it falls still within, you know, straight between our risk to reward trade parameters. So that's something I'd be looking to do actually. You know, we've got some support of the 200-day moving average. You know, just eyeballing some support there for a couple of day play, and you know, we're looking at a 50%. You know, with all of my plays, I look at a 50% max profit to get out of the trade and to reload. Just because I find that you hit 50% max profit much quicker than you hit in the second from 50% to 100%.
And we all know the Fed's going to come in and start buying just straight Apple.
Yeah, at some point, absolutely. You know, it doesn't surprise me. Bullard and Fisher and all those monkeys coming out and doing whatever they need to do to keep the market propped up. So in terms of Apple, let's get back onto the chart quickly. Okay, so we're doing the 119, 116.
So you do the retracement.
If you go into the daily a second, we would just want to see where the 119. So the 119, you know, sits at around the 200-day moving average. So I'm more than happy to sell that. You know, we're collecting good premium on it. And as soon as we hit 50% max profit on any sort of rally back to, you know, some sort of mean 21 period moving average, I'd probably be looking to sell calls there as well. Whether or not we'll be able to get into the trade before earnings, I'm not quite sure, but you know, I think that's a good play at the moment.
Cool. Let's take a look at some futures now with oil, which has taken a huge hit in the past few days. Let's zoom this in a little bit. Again,
you know, oil's oversold here again. It's kind of the same story for pretty much everything at the moment. Short term, you know, oversold. You know, what I like the idea of here is selling puts again for some sort of movement up to around the 56 level. You know, there's 21 period moving average again, and from that, you know, I'd probably be looking to switch my play and start selling some calls. But you know, the whole idea here at the moment is because, you know, we're in a nice period of the VIX being at around the levels they are, you know, 19 and 20. We just want to be looking for any excuse to put some trades on and start collecting some of that premium, because, you know, as we all know, volatility contracts extremely quickly, and at the end of the day, on the S&Ps, what are we? Maybe 5%, 4.5% off all-time highs. So we're not that far away, and you know, VIX can contract extremely quickly.
Cool. What else do you want to take a look at?
Yeah, let's take a quick look at the S&Ps actually to see how they're getting on. I think they're just whipsawing around at the moment.
Let's look at the futures.
I mean, you can see here, you know, look at the average daily moves. You know, there's the big average daily moves. However, if we were to put that into context, if we go into the trade page and actually look at the volatility levels, you know, the average expected move, you know, for example, for a day, which today is $14. Okay, and between now and next week is 48. So, you know, it's twice as big as what it used to be. So if you guys are looking at the S&P thinking, you know, this is some big moves that's going on, in context of its standard deviation moves, you know, it's still normal. It's just this is what you get when, you know, volatility explodes.
Yeah, exactly. The S&P's kind of come down and settled in this kind of 2050, 2040 range.
Yeah.
The past few days.
I did actually a nice play yesterday. I actually caught the top of the move yesterday morning. I actually did a nice notional value play. I did the notional value play of the Russell to the S&P. I thought that you know, I'm not sure how much you guys have done notional value. Maybe it's something we could do to set up a webinar sometime. I thought the S&P was relatively overbought compared to the Russell.
Yeah.
So what I did was I sold X amount of contracts of the S&P futures and bought X amount of futures in the Russell, and expected some sort of reversion between the two prices. And that's exactly what we got. You know, that was a nice intraday play, and a very nice notional value for futures as well.
Cool. Well, it's we'll get onto that in a later webinar.
Let's take a look at the euro actually, as the last one before we go on to some questions.
Wow, that's a big move.
So we can see it's breaking out actually. If we were to draw a trend line from the top here down here,
through here.
Yep. So we can see it's broken out over the past day. So any pullback on that is a potential buying opportunity. You know, selling calls. I don't do much spot forex anymore. That's what I did when I first started to get into trading. Selling some puts, or buying a few debit spreads or something. It made a really nice rounded bottom here, inverted head and shoulders, broke through the trend line, and away we go to the races. And that was actually one of my key technical setups when I first started to trade. And whenever I want to play around with the euro and the currency markets, it's still the number one strategy I actually use.
Yeah, what we've seen with the euro, or at least any of the currencies, just keep it simple. Only use 1 or 2 indicators and not try to complicate yourself too much.
Yeah,
So.
and I think that comes into everything as well. When we come into these questions in a second, I think my trading strategy and my returns got much better. Probably by 50%. My success by just keeping my trading strategy simple.
Yeah.
Instead of having 10 technical indicators up on your chart, have one. I kind of only use Bollinger Bands and the odd trend line just to see how trend reversals and things like that. So the simpler you guys keep it, the better your returns are going to be.
Cool. So let's get on to the questions.
Yeah.
Bring this up. All right. Okay. So which one do you start with?
Let's start off with the Greeks actually.
Greeks.
How do you
study and trade
Greeks?
based
How
on
do you study and trade based off them? Okay, so the Greeks that I mainly focus on is delta and theta. It's always nice to be aware of your gamma and vega risk when selling options. However, my bread and butter is looking at the delta and looking at the theta. I'm always wanting to be theta positive, always collecting theta. I'm always wanting to be receiving on my total portfolio invested between 0.5% and 1% of theta per day. Okay, that's what I fundamentally base my trades upon. Okay, and the delta, I always look at the delta because ideally it's always nice to be delta neutral or slightly delta positive or negative depending on your own directional assumption of the market. For example, now I'm slightly delta positive. Volatility has gone up to 20 from 14, 12, 11, and there's been a lot of selling in the market. I've been selling a lot of puts on that to take advantage of that volatility contraction. So like I said, theta and delta. One thing I also look at is beta as well. I always beta weight my portfolio to an index like the SPY, just so that gives me a quick overall diversification to an index. So if the markets do start tanking and I'm in trouble and I need to basically make my portfolio delta neutral, I know how many contracts I need to either buy or sell in that one particular underline.
Are you still delta?
I'm delta
positive.
At the moment. I'm delta positive. 2 weeks ago I was delta negative.
Oh, okay.
So but for the short term period, I'm delta positive by I think it's about 300. I have about 50 odd trades on at the moment and about 300 points.
And for gamma, I mean, you're not doing too many short term plays, so gamma risk isn't too much of an issue for you.
No, not at all. Yeah. So the majority of the plays are as close to 60 days or 50 days as possible. We'll get into this another time. I'm sure you guys listening already know a lot about theta and the theta decay curve, and that's when theta starts to kick in the best. And I always want to be there collecting as much premium as possible.
Great. All right, let's go to another question by Limbus Bread. He asks what your favorite volatility and play setup is.
Okay, favorite volatility play setup. Now, after having 7 years experience, it is strangles and naked, selling naked calls and puts. It was originally selling very, very wide credit spreads and selling very, very wide iron condors. But once you get that aptitude towards risk and you start to understand the benefits of being naked in options, and you more importantly become comfortable with the psychology of actually leaving yourself open. Okay. Your return on capital starts to increase, okay, and you can get much further away in terms of standard deviation, okay, so that your parameters are much wider. Okay, on your trading platform, you're having to put up a lot more buying power, okay, but your return on capital essentially is better, and that's what we're all looking for at the end of the day.
Yeah, exactly.
Okay, and you can think, well, if you're naked, you can blow yourself up. There's a little technique into that. It's about staying small. Okay, it's about staying I'll give you an example of my portfolio. If I'm doing a naked play, or in any trade, I don't risk more than 1% of my account size per underline. Okay, so if I'm doing a strangle, I'm not going to risk more than 1% in that strangle. Okay, and I'm always going to have around 50% of my capital invested. So if you do the quick maths, that's around 50 trades per time.
Mm-hmm.
Okay, that helps with return on capital. It helps with creating the number of occurrences for the standard deviation model, and normal distribution curve. It creates the ability to get up to theta around the ideal 1% mark, and again return on capital as well.
But it's difficult to be selling. Well, you can't really sell leg into the strangles with the smaller account size.
It's much more difficult. I mean, there is an art to doing it. Your return on capital again does increase because essentially you're selling into strength, selling calls into strength, and selling puts into weakness simultaneously. So you are kind of effectively having a strangle on, but you're managing them each side differently.
Yeah, exactly. And obviously we like to sell vol.
Always sell vol.
Yeah.
Now, when I was first getting into it, I bought a lot of options. Now, over the past 3.5-4 years, it's always been selling options.
Mm-hmm.
Always, I understand the analogy. It's just logical to me. I'm always wanting to be collecting theta, getting paid for taking on the risk, rather than paying to take on the risk. It all comes down to probabilities at the end of the day for me as well.
Yeah. And I think the longer that you trade, the more focused you are on just hitting monthly returns rather than looking for that big elephant trade.
Yeah, exactly. I always focus on putting on as many number of occurrences, as many trades as possible, number of occurrences, sticking to my percentage of theta I'm collecting per day in relative terms to how much I have invested of my overall portfolio.
Yeah.
And it's always trying to stick to a certain probability of being out the money.
But I guess let's move on to the next question, which kind of ties into this by Indigo Reality. And he asks, how long did it take you to turn 500 into 7 figures, and what were your most successful trades? And tying into what we previously were talking about, your strategy that you have now has evolved considerably over time. And the trades that you were making when you had $10,000 versus now are much different.
Absolutely. To answer that question directly, it's taken me 7 years. I'm now 23, coming up to 24. I started when I was 16. I actually started paper trading and learning how to trade when I was on my 13th birthday. I started off in Forex, technical analysis, so completely different to my more mathematical approach now, looking at things like the MACD, the RSI trend lines. I turned that into 20,000 and then started going into the options market then, when I could actually open an account with $20,000. So I'd say 50% of my earlier trading was in the options market, was always buying calls, buying debit spreads, buying put debit spreads. And then it started to slowly move away from buying always premium, always buying calls and buying puts, to buying maybe 50% calls or puts or debit spreads, and then selling the other 50% in premium, just try and start offsetting that theta decay in the premium that I was paying for the calls.
I mean, did you fully understand theta and volatility when you started trading options?
Yeah, I actually started to study options. It's right when I was 17 actually. I had some very fortunate guys who were teaching me this type of stuff. So it took me about 1.5 to 2 years to actually fully understand the Greeks, theta, delta, gamma, vega, and why. Not necessarily why, because it kind of once you've been told the logical explanation behind why you want to sell options rather than buy it, if it doesn't hit then it's never going to. Okay, it's just one of those logical things that either comes to you or doesn't. Yeah. And I always had the logical thought process there of, okay, it makes sense, but I always had the problem with actually implementing strategies into doing that.
Yeah. And what was your most successful trade?
My most successful trade was on Tesla. Monetary terms, it was around $73,000. It was over 2 weeks period. It was over a 2 week period, and yes, I'd bought a lot of calls. It was definitely luck. It was a mix between one of the momentum technical analysis setups I was having mixed with a news announcement, Okay, and
got lucky.
Yeah, and a mixed with a lot of tape reading as well.
Yeah. One thing that we really want to get across is that you can chase these big trades,
Yep.
and they come along every now and again. But it's more important to focus on your total monthly earnings that you're making.
Yeah, like now it's about when I first started options, it was very erratic. One day I'd make 1 week I'd make 10 grand, the next week I'd lose 7.
Yeah.
Okay, and it took me about 6 to 8 months to actually start developing a more consistent approach, even when I was still buying options, to actually kind of do a zigzag equity curve, going from bottom left to the upwards right of the page, of making 10,000, losing 2.5, making 10, losing 2.5, making 10, losing 2.5. And now for me, it's just mechanical. I want to stay mechanical. I stick to the same probabilities. I stick to a number of occurrences. Okay, I have 3 trade parameters, which is just extremely mechanical. I manage my winners at a certain percentage of max profit, and I look to reload on trades as well.
Yeah.
So now, much more mechanical. I'm making more consistent, smaller but more consistent returns, and doing it on a more regular basis as well.
So it's, instead of looking for the big trades, it's better to be more consistent.
More consistent. For me, I'm trading to trade for my life, for a lifetime. I want to live another day. I'm not trading to make a home run trade, because the stories of those people, they usually end up in one way. Look at China.
Yeah.
Look at China now. It's one example. Look in 2008. Look at these guys. So you're always looking to fight another day. Absolutely.
Cool. And what was the biggest breakthrough?
My biggest breakthrough was actually moving from buying premium to actually selling premium. That was by far my biggest breakthrough, because like I said, then my returns started to remain constant. Okay, my returns were smaller, but they were less erratic and more constant. Therefore, like I said, my successfulness in my trading increased by around 50%.
Yeah. And if you can stay consistent and make 3 to 5% a month, that's really big over the entire year. It may not sound like a lot, but if you're making consistently 3 to 5% every single month, you're gonna double your portfolio within 2 years.
Exactly.
Yeah. Absolutely.
I mean, the clients that I trade for now, what I'd say to them, and I say to everybody else I talk to as well, is all you wanting to do is beat what else you can get out there. These fund managers who are returning 4, 5, 6%. All you wanted to do is beat that.
Well, the first goal is to beat the risk-free rate of return, which is essentially zero right now. So as long as you're not losing any money, you're doing okay. The next is to beat the S&P, which has been difficult.
I mean, it's difficult. I mean, I think over the past 2 or 3 years, it's difficult to try and beat the benchmark, simply because it's just going up and up and up and up.
It's on that treadmill,
so it's a very.
But you can do it though.
You can do it, absolutely. I've done it year on year for the past 5.5, almost 5 years now. So you can do it. It's just
takes more work.
It takes more work, and it's more difficult to do.
When volatility has been suppressed like this, you have to become a bit more creative in your trading.
Exactly. I mean, if you can, let's say, if you can be returning 10% per year, for example, when volatility levels are around 12, okay, you're gonna hit it out the park when volatility levels are around 20 to 30, even 40, back to the normal, back to the medium, back to the mean, should I say? That 10% is going to turn to 20, 30, 35%.
And Jamal Crawford here asks, someone with experience understands the options and about is able to open up a book and maybe write down or complete a test about how calls work, how puts work. Where does the experiential side come into it? More the heuristical understanding of how to set up a trade and what sort of strategy to build behind oneself. I
think it's obviously there's no one golden rule to trading. There's no ever one golden strategy. My strategy doesn't work 100% of the time. No one else's does. Okay, I think it's just finding a mechanical approach that you find most comfortable. Okay, because you could find I've found many strategies before that can make money. Okay, and make good money, but I've never been psychologically and personally comfortable when I've been in those trades. Okay, so you always want to do what's comfortable for you. And creating just a very simple mechanical approach in order to do that. Okay, play around on the demo account beforehand. I still do a hell of a lot of demo account trading to practice new strategies. Okay, which I don't want to implement into my live account yet. And it's just allowing you to become accustomed to the strategy, become accustomed to the underlines in which you want to trade. So definitely, you know, maybe it's something we could do a webinar on actually.
Yeah, I think it's something we will do about how to develop a trading strategy
and a trading plan. You know, maybe I could
plan.
show you guys my trading plan that I have, and talk you through my trading plan and how I implement the ideas that I've learned into real life in order to make money.
Or we could go the one that you set up for me, and we could go through that one.
Yeah,
that's probably
absolutely.
a little bit easier for people to understand and to put in practice.
Yeah, so I think, you know, the one you have at the moment, Sam, it's about just understanding about putting on a number of occurrences and volatility.
Yeah.
It's not necessarily about being correct directionally. It's about number of occurrences. It's about collecting theta, taking advantage of when volatility levels are higher compared to what they've been, and yeah, I suppose that's about it really.
Yeah, cool. I think that covers everything. We'll be back later today. We're going to go over some successful trades during the week and what we did to find them and to get in and out of them, just so we can provide a few examples of what we're doing.
Yep.
Instead of just doing the kind of looking forward. And if you guys have any questions, make sure just to leave them in the comments below. Don't forget to subscribe. We're going to keep these videos coming, so subscribe to them, and we'll see you next time.
Yep, absolutely. See you.